All right, hey guys, it's me from the future. So I just want to make something clear, and what I'll say is the way how it is, because it isn't something that I didn't really specify before. So let's just be on solid ground about this, and I want you to pay attention to this because before I wasn't super clear to explain it. When you're in options, in this case, you're learning sellers, right? When you're a seller of a call option, you are obligated to buy those shares at the strike price. So let me give you an example. If a stock is currently trading at $100 and you decide to sell a call option at $105, but then let's say the stock goes up to $115 over a period of time, and you let the option expire. Well, if you let the option expire when the stock is currently now trading at $115, what will happen is that you'll be forced to sell those call options at $115. I mean, sorry, at $100, then rather 115. So you took in a loss. You'll be forced to sell at $100 and not take that $10 gain. Okay. And then if you're the buyer of a call option and you do the same thing, let's say that now you're in the other perspective, you bought that call option. Okay. And then that call option was $100. But you bought it at a strike of 105 and eventually went to 115, you just made a $10 gain. But if you let it expire at 115, you will actually be able to buy now 100 shares at the strike price. So you'll be able to buy it at $105 and actually be currently having unrealized gains of about that $10 difference, which is about $1,000. Okay. That's very important. Now, for the put side, the way how it works is that if you're a seller of a put, you have the obligation to buy those shares at that strike price. So if a stock is currently trading at $50 and you buy a strike price of 45, but then later in the future the stock eventually goes down to 35, that means that there's a $10 difference and you let it expire at 35, you have the obligation to buy 100 shares at the strike price. So the strike price was 45, but the stock is currently trading at 35. So you're making about a $10 loss, which 100 shares, that's about $1,000 loss. That's for sellers. Sellers only for puts. For the buyers of puts, it's the other way around. If you buy a put at 45 strike price and you let it expire when the stock is at $35, then you keep the $10 gain because you're selling. So you'll be able to sell your shares at $45 at a higher price, and yeah, $45 when the stock went down to $35. So you minimize your losses. Okay. In best case scenario, what I would do is that if you're selling puts, this isn't a definitive answer though, because of I'm not saying that what I just explained isn't, but I'm saying that what I'm about to say, like if I wouldn't recommend all the time to sell at the same price the stock is trading at. So if the stock is at $50, I don't always recommend to sell puts at $50 because it depends on the scenario. But in this example, if you sell puts at $50 and it goes down to 35 and you let it expire when the stock is at 35, virtually you made almost no losses because you sold before you took losses. So, and then if you that's for buying puts. Okay, super important because I wasn't that clear about that before. Now, I'll just quickly say this because selling options may not seem so attractive because you think, well, what's the point of selling a call, for example, if the stock price goes up and I don't make money on that. And same thing happens if the stock goes down, I don't make money either. Well, that's the point. When you're the seller of, well, let's say if you're the seller of puts, no, it's not like that because I get confused sometimes. Even I've been doing this for almost 7 years, and I even get confused about it, which I think is hilarious. That's why it's kind of funny that I'm saying this. I have like 7 years, and I sometimes forget about this because I don't do it that much, to be honest. So I don't do it. I don't really sell primarily to acquire shares. That's not the way how I kind of invest. So that's why it's something I have to like remember. I know a lot of people that do it. That's why I want to show it to you guys because it's still something that could be good. But if you if you sell calls, if you're the seller of an option and that option expires worthless, so it's not in the money, nothing happens. You're not assigned shares because it's expired worthless. The put buyer expired worthless, so he's not going to acquire 100 shares because it's not in the money. So you don't have the obligation to give him anything, right? So it's like that agreement with the buyer. If the buyer doesn't have his options in the money about to expire, then you don't have to deal with that assignment or that exercise. Right? You don't have to deal with either buying 100 shares or selling 100 shares. Now, for a buyer, you have the option to do that. So in this case, what I said before, which now that theory works, not for selling. So when I said that if a stock is currently trading at $100, you sell a call at 110. The only reason you're doing that is really mostly for trading. You're very confident that the stock is not going to expire above 100, 120, right? It could be fine if maybe it gets close to 120, but it's mostly important that the stock doesn't expire above 120. Okay, right, over a period of time. And then for puts, it's the same scenario, just backwards. If you're selling puts, you want to make sure that that put expires worthless, so it's not in the money, meaning that it could be in an uptrend, right? It could be far off. It's mostly for trading, right? And I'll explain that later, in videos coming, because it's a reason why selling is good. I actually sold a lot of options when I did option swing trading and just option trading in general, because they were so consistent. A lot of the times they were overall very consistent, because when you're selling options, you don't have to be right about the direction so much. Like that's kind of the consequence of being the buyer of options, that you have to be really right on the direction, or else time and volatility will be very against you, and also intrinsically. For the sellers, it's actually the opposite. If you're the seller of options, you make a lot of money as long as the price stays away from the strike price, and time passes on, which happens a lot of the times, right? But there's a pro and con to that, because you might be thinking, okay, then why don't I just buy very far out strike prices? No, because those very far out strike prices have a low probability to expire in the money, so they're not going to cost anything. So you're going to probably be collecting like $2 or something like that, and I mean, and you have to reduce commissions and fees and all these types of things, and like margin balances if your broker requires it or stuff like that. So it's not that simple, okay? It's not that simple. But it's a good way to make money, to make cash flow a bit. All right, so let's get back to the video. All that stuff is fully backed up. I did the research and everything. Back then, I think it required a bit more clarification that I didn't give. Okay.
Hi everyone, welcome to this video. In this lesson, we're going to be talking about selling calls and selling puts. So in the last lesson, we talked about how to, what a call and a put is, and really how you can benefit and how to best utilize buying calls or buying puts. In this video, we're going to be looking solely on what makes a seller of a call, how to benefit from it, and when you should be a seller of a call, and when to be a seller of a put, and when how to benefit being a seller of a put as well. So let's just dive right into it. So when you're a seller of a call, you get to collect the premium right up front. So in selling, you will be entering the trade with a credit. You will be paid for entering the trade as of itself. So in the other case, when you buy a call, you actually have to pay a debit. You have to actually pay what the premium costs. So if the option costs $1, you're going to have to pay $100 for that option contract. But when you're a seller, you're always going to collect a premium, which is a credit, because you don't have to pay anything because you're selling. Now, this doesn't mean that you already made the profit. No, not at all. You make the profit either when you buy it back or when the option has been expired, worthless, because you collect the premium. Of course, which I'm really going to talk about entering the credit, you will see your net liquidity to be higher from trade, like if you were already winning. However, this is just what the premium is. You only make the entire premium if the premium in the contract went worthless. That way you keep the whole premium. So let's say if you sold a call strike at $2 above the spot price of $50 for an expiration for 14 days. Now let's say that seven days has passed and the price fell to $45. That call option will now be worthless, despite there being a little theta, because the price went down, which made the premium worthless. So, but this is great because you can buy back lower. So your point as being a seller in a call and a seller in a put as well is that you want to have the premium be lower. And obviously when the price, because you're selling a call, you're going to be really shorting in this case, because you don't want the price to be at your strike, or else it will increase in values, especially intrinsically. But in this case, since it's out of the money, it'll be extrinsically. So as time passes on, like 7 days, and the price went really against it, well, it definitely will be worthless now. So in this case, let's say that you looked at an option that costed $30. So you sold an option that costed $30. Now it's at $1, which in total made you a profit of $29 or more if it expired, if it went worthless. So you benefit really as the seller if the premium loses its value. As a seller, you benefit when the premium goes down. That means that you benefit as well when there's a time decay, which means by every day the theta loses value, because buying a call option loses value as it gets closer to the expiration date, which is beneficial for the seller. This is called being net short on theta. You benefit when theta decays because you get to buy it back lower than you sold it. So when you're a seller, you actually benefit with time decaying. So you'll see when you short an option, when you look at your theta is going to be positive, because as long as the spot price is below, in this case it's a call, if it's below the strike price, obviously if it gets close to expiration, that option is going to expire worthless. So if it gets to expire worthless, you get to collect the premium because the premium is much more smaller than what you sold it for. So it's actually the exact same thing as shorting a stock. In options, you always want to sell high and buy back low. Or in some cases, if you have, in this case, it would be like a cash secured put, where or no, actually, sorry, it would be a covered call where you're selling calls, and if it doesn't reach it, you get to keep it, right? But in covered calls, that's more for stocks where if it goes above, you keep the stock itself. But in this case, theta, you actually benefit from theta. Remember that when I said that when you buy a call, one of the biggest disadvantages that you have is time decay. That's why a lot of people get 90%, more than 90% of everyone in the options, in the option market, don't win money because they don't understand the time decay. So they buy the wrong things because the time decay doesn't work in their favor. They buy expiration too small. That time, there's not enough time value. So think about it. When you want to sell a call, obviously you want there to be as a little time decay, or that time decay decays very fastly. Because if it decays very fastly, you get to collect the premium as it gets lower in the price because you sold higher. Now, as the seller, you're always going to be the counterparty of the buyer. You're betting against the direction that person will always take if they're buying. Being a seller is best used and done when volatility is high, which shows options are expensive and that it's in a downtrend, because in a downtrend, the prices go down more than when it goes up, because it's net downward in a movement than up. You should always sell when there's a rally, when there's been a rally now, but you see that it's hitting a strong resistance, like similar to this year. You could have done a lot of these, and if you do that, there's a less probability for that price to continue to rally rather than the price continuing to go back to the actual trend, which is the downtrend. So with downward movements, remember that with downward movements, they move sharper. Whenever the price goes down, it goes down faster than it goes up sometimes, which can possibly make your premium worthless faster before expiration, which helps you as being the seller, because you want the premium to be worthless, because you want to buy back lower, so you can collect sort of like the spread between there. So when you remember that in selling a call, what you're doing is you're going to be selling, as I said here. So this example, I said that you were selling a call $2 above the spot price of $50. So like, let's say that this was in a downtrend and the price was rallying and there was a resistance, let's say like a really strong moving average with some horizontals and a bearish reversal sign. So you would sell a call at a higher strike price. That way you see that it's very hard for the price to hit that strike, because there's so much resistance that even in a downtrend, the trend goes downward more than what it goes up, what it's been doing recently. So if you do that and the price goes down sharply, which it always does in a downtrend, in downtrends, the price moves sharply because of fear. People sell more in fear than what they do in buying, and eventually. Now, in the long term, people buy more than what they sell. But when they sell in a fast quantity. But sometimes the fast quantity isn't enough to offset what the bullish enormity of the entire trend has done. That's why you will always see the S&P do higher highs and higher lows. And on top of that, there's productivity that's growing. So kind of to sum this up, like when you're selling a call, you should always sell it in a downtrend, because it's less likely that the price is going to go up and hit your strike, which obviously is a bigger probability. We always want to enter things that have a bigger probability, that I've explained also in stocks, that I never enter anything that's a 50-50. So ideally, you do want to be selling calls when it's in a downtrend, because it's less likely to go up. Now, what's a seller of a call then? Well, a seller of a call, remember that a seller has the obligation. When you buy a call or a put, you have the right. But in this case, because if you're selling a call, you have the obligation now, not the right, but the obligation to actually sell 100 shares at the predefined price if it expires to the buyer. So remember that when you buy a call option, remember that you had the right to buy 100 shares at the price if it expires. Well, because it's, remember that between an option, it's a contract between the seller and the buyer. Where are those 100 shares going to come from? Well, from the seller. So in this case, because you have the obligation, you're not going to be buying 100 shares because your buyer's looking for the calls, looking to buy the shares. Because remember that the way how options work, this is why I wanted you guys to understand this fundamentally, because whatever option you will do, if you understand the relationship and the entire structure and purpose of what options were and what options are, is that they're mainly seen as like that sort of investing in a few shares of the company, or many shares of the company. So a buyer of a call has an advantage when their strike price, if it's a call, goes below the spot price, because it shows that the price right now is higher than what you bought it for the strike. So obviously, by that purpose, a person who wants to exercise the option likes to do it when it's in the money. So when it's in the money, you get to gain the valuation intrinsically, like if you were owning the stock with 100 shares per contract, right? So if you bought one contract, that's 100 shares, so it'd be $100. If it's two contracts, $200 because it's 200 shares. Now remember that when you're a seller, you're going to sell those 100 shares if it expires. If it expires, so you have but you have the obligation though. You have the obligation. We'll talk about that much more in depth when I talk about. Yeah, I'll talk about that in the few upcoming slides, because that's very important. So you won't be scared if something happens. Like, those are sort of things that you should have as an expectation. Now, another part of a seller of a call is that, because the seller has the obligation. If you are selling a call and it expires, you are obligated no matter what to short 100 shares, even if you don't have the money. And that's called selling naked. I never ever let this happen, because I never sell naked. I never do. And you shouldn't, because it's very, very risky to sell naked. Selling naked is first when you don't have the money, and then the shares happen to. So selling naked means that, let's say you decided to sell a call right here, right? You decided to sell a call, and you didn't have anything offsetting the other option, because you decided to only enter with one single call, which you were selling. This is called selling naked, because what it means is that if the call manages to get in the money by expiration, and you didn't have the money, that's called selling naked. So this could be very risky. There's some people who do money like this. The reason why they do that is because they're able to utilize selling options without actually having the money to back it up. There's sometimes, like, you could do this with brokers, but it's very risky, because if you don't, if by somehow the options have been exercised, which is possible, you would end up losing almost either a big portion of your account, or almost all of your account, because you didn't have enough money to back up the 100 shares. So for me, I never sell naked. I always have a different strategy to offset the other sell, and net, I would be able to close both positions, which will make me not hold anymore, or not hold at all 100 shares. So again, I'll explain this in an enormous amount of detail with certain strategies in the few lessons when you guys understand the strategies. For right now, we're learning a lot about the basics. As a seller in its nature, though, you should be careful, because you're selling an option. There is a possibility for the price of the option to go up, and as we know it, an option can go up in value infinitely, which is risky, and only lose limitedly, which is the premium. But I will show you how to get around this. So when you're a seller of a call, at expiration, you are the seller in shares for that buyer, if the buyer decides to assign 100 shares before expiration. Now, that could happen because, remember, the buyer has the right. They have the right, which means they could assign their option whenever they want, even if it's before expiration. Now, a lot of you might be like maybe repelled by now, but let me explain this, because this isn't like just, that's sort of like black and white. Now, this almost never happens, because when you're a buyer of an option and you exercise early for some reason, let's say for the reason being that let's say you bought a strike price of $60, but the price now is at $62. So let's say in total you had to pay $4 for the option. Two of that was from intrinsic and the other two was extrinsic value had. When you exercised early, yes, you get to hold the stock for less than it's worth, for less than what it's worth now, but you don't keep the premium you paid for it. If you're waiting by $2 by the stock, that's cool, but you're actually losing in total of the entire sale in by $2, which literally would be entering $2 above what the price is at now. So let me explain this in a simpler way. Remember that I said that you bought the strike $60, right? And the price went up to 62. All right, so we know that if you exercise the option, you're buying the stock for a lower price, less than $2, and on top of that, you're gaining a $2 profit because it's not 62. However, when you exercise an option early before expiration, you don't keep that profit. You get to exercise you get to exercise the option at the strike price if it's in the money. However, you don't keep the premium. So if the premium's $4 and you only made a profit of $2 from 60 to 62, in reality, if in reality it would have been like if you were entering the option now at $64 rather than 62, which is really stupid. So I wouldn't even do this at all, because you're actually entering higher than what the price is now, which is what you don't want to do in options. So this is why this rarely happens. I think the only person who would do this would be either accidentally or that they're just kind of idiot, because you'd be losing if you do that. Now, when you decide to exercise early, again, you lose the call and all the premium it had, which isn't good for a buyer. Net, they will end up losing in total, which you can see is irrational if a person does this. Now, however, a part that could be somewhat motivating the reason for a person doing this, which is very, very rare, very, very rare still, is if they want to receive a dividend payout tomorrow. So for some of you who know, if you haven't been in the stock market, or for some of you who are in the stock market, maybe you might know what I'm talking about here, is that, when you hold a stock, you get to earn a dividend if the company pays dividends to their shareholders. So sometimes what could be a motivating reasons is that if a person decides to be that buyer of the call and he sees that the dividend payout is tomorrow, he will decide to exercise the options today in order to receive the dividend payout of tomorrow, because if he holds the shares of today, he will be able to receive the dividend that the company pays out, and maybe he might sell right after the dividend payout, or maybe hold a position. I'm not sure, but this rarely happens because no one does this sort of way of using options, because it's complicated and it's really dumb. Because you're losing $4, and yeah, you're receiving dividends, but I don't even think it's enough to offset your loss. Like, it's just a very complex, stupid combination of doing this trade. So, but I want to let you know that's why the buyer has the right. When you have the right, it means you have you can exercise the option whenever you want. You just need to let the broker know. But remember, when you exercise the option early, you don't keep the premium. So, majority of the times you're going to be losing in total if you exercise the option earlier, even if it's in the money. So I wanted to leave that clear, because this is somewhat like in the gray area where people don't understand. Now, I want to talk about the P&L graph of selling calls. So in this case, this is Metaverse, and actually this is now a real time of the P&L graph and how it looks like. You can see that when I started talking about the buying calls, it looks exactly the same. You can see that this is the amount of money won or lost, and these are all these share prices. Now over here, I guess it looks a bit technical for a person who meets it the first time, but this represents the option itself. So this is the call option. This represents the strike price. This is the expiration date, and this is the amount of quantity of contracts you're going to sell. So right here I'm selling December 2nd at 119 call. And the credit in this option is $136, as it shows here, or $1.36 by 100 shares. So the call strike again is 119. Let's say I entered this on November 18 and it expires on December 2nd. Right now the spot price is at $111.72. So what I want you to understand in selling calls is that if you look at this graph, you actually have your profits capped, meaning that no matter how, because when you're selling calls, you actually benefit when the price goes down. But you can see that no matter how far the price goes down, you're going to make the exact amount of money. And what's the exact amount of money? What's the max profit? Well, it's the premium. It's going to be $136. But you see, if the price went up, you have an unlimited risk. The price could go up infinitely, and you could lose up to as much as you want, like losing. So For me, though, I never allow this to happen, and I never even allow it to get close to the strike price. Because remember, if you guys remembered in the buying call section, remember that at expiration, when you buy a call, you still lose all the premium, right? Because you don't have any intrinsic value left. At expiration, there's only intrinsic, not extrinsic, because all the time value got wiped out, which wiped out the volatility, of course, because there is no volatility anymore. Now, this is the same case. Like if you because this is now the opposite. Your actual break even level at the expiration date is always going to be, in this case, if you're selling a call, it's always going to be your strike price plus your premium, which would be $120.35. It's this number right here. So that's just something very important. But the great thing about this is if you look at this, and I'll show you in real life. Let me look at the chart so I can show you guys. This is the P&L graph of this option. So in order to get this, you have to put the stock symbol and put the call option you're looking. So in this case, in order to find this is 119 call. So I'll explain this in the next video. I'm going to look at the option chain. This might look very confusing to you guys, but this is just how to get that tab to the risk profile, which stands for the P&L graph. If I go to that option and I decide to sell, which was that exact strike price at the, oh wait, no, this is a different expiration. December 2nd, it was 119. What you do is you right click it and you click on analyze. And that will automatically bring you to the risk profile, which is the P&L graph. So I want to show you that you can see that when I move my cursor, if you look at this box, remember that the purple line represents the day of today. So right now it's, November 20th, but I bought it November 18th, but let's just look at November 20th because it's today. If you look as the time's going, you can see that the purple, you can see these numbers on the purple line starts to change, right? It starts to go negative and then positive. So something very important to understand here. Remember that because you're selling a call, remember that if the price goes down, you're going to be losing money as of today, but that's something temporarily. Now, why are you losing money? Well, that's because remember that there's still extrinsic value left. So if the price goes up, obviously, you guys know that when you still have time value in a contract and a price goes up in a few days easily, the buyer makes a lot of money. And that's why you see that the option itself starts to lose value, and it's easy. It's like easily loses value because the gain is infinite. You can see that the price right now is at $111. If it moves up to 114, you're already losing $66. If it goes up to 117, which is $6, it's almost like what? That's a 7% increase. No, like a 5% increase or 5.5. You're going to be losing $186. But just today though. But something very important to understand here is look at this graph, look at this column. This is called theta. If you guys remember, theta represents the time value. When you buy a call, your theta is always going to be negative, no matter where it is. Why? Because when you're buying a call, by every day, your time value is going to reduce because it gets closer to the expiration. However, when you sell a call, your theta is going to be positive. Why? Because the time value is decaying. But when you're an option seller, you benefit from the time decaying because the premium starts to reduce in value, which you make a profit when it reduces in value. So you could say in a way that at $120 at this level, you're making about $17. That's what it basically means. You're making $17 if the price stays there for today. By tomorrow, you're making 17. By in 2 days, you're making $18. That's very important to understand because by this you will understand what sort of position is the contract in right now and your trade is in. If it's positive or not, if it's doing well or not. In this case, you can see that no matter what area it's in, if the price went, which is very important, if the price went up to $117, let me add another line. If the price went up to $117, if you look at the theta, that's at $117. That's $16.49. Now, why do you make a lot more theta over here than what you make here? Well, that's because the extrinsic value as the price goes down is closer to as if it had the intrinsic, if it had no value. Because remember that you're selling a call. So we know that if a call goes down, it goes closer to its premium. It goes to zero, right? It gets closer to expiration. So that means it's easier for the contract to expire in a way, because that's why you see here that obviously the time decay over here is going to be less than over here, because there's less extrinsic value on this level than over here because of the distance between the strike. When there's more distance between the strike and the price, and the current price is over here where it's closer to the max profit, whenever something's close to the max profit in selling, there's going to be less time decay, but there still will be theta regardless. Well, whenever it's closer to the strike, there will be the most theta, because we know that when you buy a call and the call goes up to the strike price in one day, you're going to make a lot of money because of the extrinsic value, because the price was able to go up so significantly without getting super close to the expiration date, which you still maintain extrinsic value with the price going up. So this comes to the problem that if the price went above the strike price, then obviously the time value starts to decay, because it starts to form more intrinsically than rather extrinsically. So that's just something I wanted you guys to understand.